let's discuss a couple of things that we saw in the Barron's paper. So the Barron's paper, so this is Barron's Sunday, right? It's actually a Saturday paper, but it's a weekly. It's a weekly periodical, and it is predominantly focused on financial news. Financial news. Right. So this will be news segment, I believe 5. News segment 5. Right. And news review number 1. News review number 1. So this is my first time doing this, so we'll see. We'll see which one I like more, but I'm thinking that I'm just going to stick with the news review. Because in the news segment, you basically just see me reading the newspaper, and there's not much really going on that's actually valuable. So, the Barron's Sunday Weekly News. So, one of the first things, or one of the last things I read about, but that's at the top of my notes, is public sector real estate. Public sector real estate. And basically what the article talks about is that the state, local, and federal government own about $50 billion worth of real estate. $50 billion of real estate. And that real estate includes lands and office buildings and so on and so forth. But the article's argument is that this could be put to better use, right? So, for example, they talk about the Logan Airport. And the Logan Airport is in Boston, so if this is Boston, this is like the edge or whatever, right? The Logan Airport is right on the water. It's like premium waterfront property stuff, right? And so this little bit, right, if you just took the Logan Airport and moved it farther inland, where land is much cheaper, and developed on that little bit, that would be a huge return, right? So one of the arguments that it brings up is that the current real estate valuation system in the public sector is a little bit broken. And the reason it's a little bit broken is because what ends up happening is it's very limited in terms of how it's valued. So it's not valued at market price. Instead, it's just valued at whatever the cost of buying it was. Whether that was 50 years ago, 100 years ago, or 200 years ago, that's the way it valued. And this 50 billion number doesn't actually include things like public parks and stuff like that. It simply includes office buildings, ports, trading ports, and so on and so forth. And so the push is to get this into private hands, right? So on that note, and kind of having covered this, my personal prediction, I'd be interested to hear what yours is, but my personal prediction is that this will happen, right? And this will happen, perhaps not with every piece of real estate, but that there will be a greater and greater push to develop on this limited land, right? So if you're in Boston and you're in the business of developing high-end condominiums and luxury hotels, the Logan Airport location is a fantastic location. And if you can buy that from the government, almost no matter how much it costs to you, you'll be able to capitalize it. And the government, in turn, will be able to use the money that it's capitalized and that it's gotten to not only build a Logan Airport, but to fund operations and fund anything else it needs to. And so, when debt swells at the government level, we're going to see more of this happen. So, that's my prediction for that. The second piece of financial news is a repeating theme from yesterday, which is 10 years post-crisis. So it's been about 10 years, or by some accounts it's been exactly 10 years since the fall of Lehman Brothers, which was largely considered the public turning point in the crisis. And so there's a couple of things going on that point to further crisis. One, the Federal Reserve is withdrawing quantitative easing. Right, so the Federal Reserve is ending, and we'll refer to quantitative easing as QE because they are two very long, difficult to spell words. Right, so the Federal Reserve is ending quantitative easing, and what that means is that a lot of money is going to be leaving the economy. Right, a lot of the money that it was pumping into the economy through quantitative easing is going to be leaving. Right, the expectation then of the Federal Reserve by doing this is that the money supply will contract. Money supply will contract, but not too much. But not too much, right? So let's just move this over here. This is the Barron's Sunday Weekly Financial News. Financial News Review. Okay, so the money supply is not going to contract too much, otherwise they wouldn't be doing it, right? Because a rapid contraction of the money supply is actually very bad and has led to recessions in the past, right? And may lead to a recession in this case, but we don't know that yet, right? So we should expect things like asset prices, including stocks and real estate, to start declining, because as the money supply contracts and people need to continue to move those assets, they are forced to sell them at a lower price, right? Furthermore, some countries are now, so because the dollar, so when the amount of money contracts, the dollar strengthens in that $1 buys you more of foreign currencies. And what ends up happening is a lot of foreign countries have borrowed against the dollar, right? So they've borrowed in dollar-denominated debt because it was so cheap, because there were so many dollars out there. And now that the dollar is strengthening, they are essentially forced to pay back more than they agreed to, because they still earn money in their local currency, right? And this has put a strain on emerging markets, namely Turkey, Argentina, and South Africa. Importantly, another highlighted piece of potential crises is Greece's debt situation, which we've seen emerge in the past, and Italy's political situation. So Italy's political situation is such that Italy is in a position where they are not obligated, but almost required to stay in the European Union because of their contractual duties, but they may choose to do so and abandon the euro, right? They have the lowest support for the euro of any European Union country. And so what they might do is they might leave the European Union, and that could cause further ripples. Furthermore, another concerning thing about the economy at this time is China's opaque economy, right? And we've talked about this to some degree, but just to rehash, basically, China's financial situation is opaque in terms of it's very difficult to see through, it's very difficult to understand exactly what's going on and the risks that are there, the amount of currency out there, and so on and so forth, because that's kept under very tight control, right, by the government. The second thing that we don't actually understand right now is a lot of large financial asset holders, foreign financial asset holders that were very leveraged in China, are forced to sell off. Right, by the government, by the local regulators, and so on and so forth, they're forced to sell off. And so China's opaque economy is running into some trouble. Right? So aside from that, so these are some of the reasons that we could expect a financial crisis, or some of the underlying causes that could point to one. Right? But aside from that, the article demonstrates a further piece that is a problem domestically. And domestically, the problem is leverage. So one of the things that happens when you have a very large amount of money in the economy is it becomes very cheap to borrow. And it becomes very cheap to borrow, it's very profitable to borrow money and then do something with it to earn a return, because your return looks a lot bigger because you're earning it on borrowed money. Now, as borrowed money begins to shrink, those returns need to keep up. And if they don't keep up, we have a problem. So some of the ways in which leverage has grown in the economy is share buybacks with borrowed leverage. So share buybacks. So companies have been issuing debt at very low interest rates and then using it to buying back their shares, therefore owning a larger piece of their future profits. However, their future profits have to keep sustaining in order for them to be able to pay back the loans, right? We have huge growth in the private equity industry, right, which basically goes in and buys companies and restructures them and tears them apart and whatever. But they are leveraging an insane amount because of how cheap debt is and how much pension funds are actually invested in there. And then finally, we have tax cuts. And tax cuts, when they're financed because there is too much money in the economy, or tax cuts are financed because the government is making too much money and it wants to reduce the strain on its citizens, are okay. But tax cuts financed by the Treasury, which means the government is borrowing to keep up with tax cuts, is another form of leverage. And another thing that we could see blow up in people's faces. So aside from leverage, we have a few other domestic problems, right? One of them is public pensions. And the article mentions that the amount of outstanding public pensions that are currently not covered is $4 trillion. To put that in perspective, the financial bailouts at the time and the whole crisis was $500 billion in 2008. So we're talking about a magnitude larger in terms of how this could turn out, and no real end in sight, right? That's one of the reasons that our prediction for the real estate market changing in the previous article is such that it's very likely to happen as more and more debt gets piled on. So one of the things predicted is social tension, and that's something we're already starting to see in day-to-day life and in the news and in the media, and was similar in the 1968 financial crisis. Right? And one of the reasons is when people are fed and they are happy and they have income and they're achieving their dreams and going through their goals and so on and so forth, they're not too worried about social stigmas and everything else, right? They're just not concerned because they have enough to deal with on their own. When people are hungry and they have problems, they need someone to blame. And when they need someone to blame, they usually turn and create social tension. So that's something that we might see emerge as well as a result of any kind of economic downturn. The one benefit or the one plus side of an upcoming, if it happens, an upcoming financial crisis is that if you weather the storm, you can buy in. And now this is a two-sided coin, right? The first side of the coin says, well, everybody's invested and, the dummies are going to take the loss and I'm going to wait until after the financial crisis and buy. Now, of course, if everybody's sitting around waiting until after the financial crisis may not come for a long time. One of the things that enables a financial crisis is active participation in markets. So if everyone's expecting it, it's not likely to happen anytime soon, at least not domestically, right? However, if you are in the markets and you're able to hedge your bets and you're able to sustain a moderate loss, you will be in a good position to go ahead and buy assets at a much cheaper price level, which is where they're expected to go as quantitative easing stops or quantitative tightening continues, right? The second topic covered in the newspaper today is emerging markets. So emerging markets have been on everyone's mind, and the fear is contagion. Right, so if you looked at the news just a week ago, contagion wasn't even a question. People were saying that Turkey is isolated, Argentina is isolated, now South Africa has joined that bill, and a few other things. And the fear is that emerging markets tend to rise and fall together because interest rates in countries that predominantly lend out money is going up, right? So what's happening is the U.S. rates are rising. U.S. rates are rising. Now what that means is that U.S. bonds are paying more. And traditionally, U.S. bonds are considered safer. And so, if you're an investor that was looking to earn 5% returns, and now, you used to be in emerging markets, you used to be in China and Argentina and Turkey and Brazil and Russia, earning those returns, and now you can bring it back into the U.S., where you consider it to be safer and better accounted for and have a better understanding of what's going on, you're going to bring it back. The problem is, as money starts flowing out of emerging markets and into the U.S., emerging market economies suffer, and they suffer quite greatly. So, on that list of current concerns, right? At the very top are Turkey and Argentina. But people are starting to ring the alarm bells on the following four countries as well. Brazil. Now the fear in Brazil is similar to that of other emerging nations, which is rising interest rates will force money out and put them in a difficult situation. But as Brazil is a centerpiece of the South American economy, right? It's kind of like the big the big go-to developed market in that region. And if Brazil starts failing, that means all these surrounding economies will have trouble, right? That's the reason that Brazil is kind of being kept a close eye on, right? The second country is Russia, which has a litany of its own issues, but may be hurt by U.S.-denominated debt and is also under huge amounts of sanctions. The third country is South Africa, and South Africa has been coming up more, and we'll discuss in a little bit more detail exactly what's going on with South Africa. And then the fourth and final country is Indonesia. Indonesia. And here the dollar-denominated debt, and actually the weakness of the yuan is the fear. The reason the weakness of the yuan is the fear is because if China ends up having financial troubles, they are the center, just like Brazil is the center of South America, they are the center of the Southeast Asian and Asian economies, right? So any nation that relies on the yuan for its trade and for its debt and so on and so forth, and really for its investment, is going to be weaker as well and much less able to sustain the drop, right? So those are the countries that are kind of major problematic pieces. Okay, so as we move forward, we'll be looking at these emerging markets and we'll be looking at what exactly is happening here and whether or not the problems are coming true, right? So a couple of the events that are going on that are adding to this issue and this concern is that trade tensions continue. Trade tensions continue, especially between the U.S. and China. And what that means is that the longer they go on, the more China suffers, right? The U.S. is better able to bear damage like this, and that's one of the reasons we've entered into these trade agreements, is that the current administration believes that we have leverage. And when you have leverage, you should be using it, right? That's kind of the understanding. Whether or not you agree with that is up to you. However, that's where we are today. And finance is a lot less about what you agree with and a lot more about what's actually happening, right? And China is not as able to sustain that, right? And so if the yuan keeps declining, if we keep seeing asset prices fall, if we have the start of a financial crisis or the start of a recession happening abroad in China, that could negatively affect other emerging markets, right? The second thing is that in Brazil, we're coming up on elections, right? And we've had more and more candidates kind of file out. And if you imagine this as the spectrum of left-wing and right-wing candidates, or, in more particular fashion, just candidates in general, right? The current front-running candidates are far to the right and far to the left. So there isn't a centrist candidate, right? There is no one in the center right now that's running, and there likely won't be. And markets tend to prefer centrist candidates because centrist candidates, right, tend to appeal to both public interest and and business interest. And business interest is actually very important for a country. So the Brazil elections are another major event that's going to be, a standout piece of news, right? The third piece is that European leaders have cut debt to Turkey. Now, this might not seem like a lot. It might actually seem like a pretty logical decision by European leaders, and I'm sure European leaders would agree with you on that opinion. However, what this means is that Turkey is unable to face financing. And if this is to be precedent for what's going to happen if emerging markets that borrow in euro-denominated bills are going to be left out to dry during recessions, then we might once again see contagion because investors won't want to stay even if it's likely that it'll happen. And as we all know, if investors think it's likely and all start leaving, it tends to happen, right? So that's another big thing to keep an eye on. And so we conclude this kind of rather negative article and piece in the Barron with the following, is that there is a positive note. There is a positive note. And the biggest positive note is that it hasn't become contagion yet. hasn't become contagion yet. That things still could change, right? And these are likely just predictions. These aren't truly fundamental problems like they are in Turkey or something like that. These are simple worries in emerging markets that are weakening overall and so might not be able to sustain this shock, right? And then the two biggest or kind of shining lights are Mexico, which has actually grown over this period, and India, which has seen only a modest decline, right? And here, Mexico is in a bit of a more precarious situation because of NAFTA and because specifically the South American and Central American economies are very closely linked. And so Mexico might be forced to sustain downfall if it happens, but they'll be much later in the chain. And therefore, so, if we imagine Brazil having a little bit of problems, right? So this is Brazil, right? And then we have all of the surrounding South American nations rippling down, right, into problems, and predominantly, I guess, first to go would be Argentina, right? But if we have all these problems, Mexico is somewhere down here on the list, so investors would have plenty of times to exit if the contagion reaches that far. And then finally, India has actually exhibited relatively positive growth over this time period because the Indian economy has been left more or less open, right? And India also doesn't tend to borrow largely in US denominated debt. They actually tend to borrow in differently denominated debt. So India, Mexico, South Africa, and a few other nations are going to be the first couple of topics that we focus on some of the evening streams in our country's spotlight because they're going to be important in the global economy. So the next article is rather short and kind of short on point, so to speak, but the idea is that tech stocks are declining in the United States, right? Tech stocks are declining. And we've all seen it, and you can blame it on different things. I think some of the blame rests with fear of regulation, right? So once the Senate starts getting any kind of whiff that stuff should be regulated, they start regulating it, right? They take a little while to actually get that whiff, but it looks like that's finally happened with privacy concerns and everything else, right? So the fear of regulation is growing. But the weird thing is that not only those stocks have been impacted, not only those stocks. And what the article points to is there is an idea of outperformers in the market. So basically, any company that has outperformed up to this point is likely to keep outperforming, right? And that's a generally good assumption until it's wrong, right? Like all good assumptions. And so, what people believe is that tech, in general, has outperformed the economy by quite a bit, right? And that a lot of the people invested in tech aren't there because they think the tech is very good, they think the company prospect is very good. They're simply following a trend. And so shocks like this, like the fear of regulation or the trials, pushes these trend followers out of the market, right? And causes prices to decline. So depending on how many of those people there are and how much fear is spread due to tech's decline, we might see a major decline in those stock prices. Now, the second piece of this article that's actually quite interesting is that search giant Baidu in China is severely undervalued compared to Google. Now, the article doesn't really offer a great explanation for this outside of, it's in China. But I'd like to offer a few from my perspective. First of all, before you label something severely undervalued compared to something else, you have to consider that there's a very good possibility that Google is simply overvalued, right? So if there is a correction, and if you anticipate one happening, it could happen in either market. So either Google could go down, Baidu could go up, or you could be completely wrong and they could continue splitting, okay? The second piece that's actually very interesting here is that Baidu is locally based in China, right? Locally based. And investors tend to have a psychological bias for investing in things that they use. This is natural just about everywhere, but if you use Google and you're thinking about what search giant to get, why not get the one you use? If you use Baidu, why not get the one you use? And there's a lot less money available in the Chinese economy. And so even when you account for foreign investors, Baidu truly could be undervalued based on what's going on. Now, you could argue that Google is better diversified and in different business lines and, could have potential market hits over time and better access to buying innovative startups and so on and so forth. But the reality is we're actually seeing this trend across tech stocks in China. So all the way across tech. This includes stocks like Alibaba, which had a huge success and is now down about 20% from its peak, and so on and so forth. So the third thing that could be happening here is this could be the start of a Chinese crisis. Right? So what we might be seeing is we might be seeing people that are locally based in China that are better connected to regulators, to current events, and so on and so forth, and don't just get their news from a newspaper or from a friend, but actually feel the economy, right? You can feel the economy. When you show up at your local restaurant or your local bagel place and there used to be 60 people there in every morning and now there's like 8, you feel like something's wrong, right? And these people can feel their local economy. And so if we're actually seeing the slowdown, and we are seeing a slowdown not only across tech but in China in general, this could be a big draw point, right, for what we talked about earlier, right? People might just be exiting the trend, right, and deciding that the trend will no longer continue. Furthermore, it is worrying, of course, that there's trade talks and so on and so forth with China, so this could be news related, right? So the fourth point here is news. This could be news and current events related, or, and perhaps the final point, this could simply be, like the article tries to indicate, that they are severely undervalued for just general reasons. And so we're going to make a prediction here. But my instinct here is on Chinese crisis. That's where my instinct here is. It doesn't mean there's going to be a full-blown recession, but I just think we're seeing a general decline in China, which is perfectly fine and probably very healthy because we haven't seen a decline in something like 20-something years, right? So if there is a decline, that's perfectly fine and perfectly healthy. Will it affect Will it affect emerging countries? Yes. Will it affect emerging markets? Yes. Will it affect the Southeast Asian region? Absolutely. Will it affect exports and everything else? Absolutely. But the reality is, as the U.S. interest rate rises, as the U.S. interest rate increases, right? As the U.S. interest rate increases, right? The Chinese hold a large amount of U.S. denominated debt. U.S. denominated debt. But their revenue is in the yuan. And so if yesterday you could have 5 yuan, and I'll look up the actual numbers for this later, but if you had 5 yuan to $1, right? For every 5 yuan in revenue that you pulled in, this is predominantly tax revenue, for 5 yuan in tax revenue that you pulled in, you could pay off $1 of U.S. interest in debt. And then for every dollar that you borrowed, you could get 5 yuan, right? Now, as the interest rate rises, the dollar strengthens. So the dollar goes up in value. And what that means is that today or tomorrow, 8 yuan might buy $1. So what you've effectively done is you've borrowed 5 yuan for $1. You've agreed to pay interest on that money, but you now owe 8 yuan. And without a way to generate dollars easily, right? The only other options are 2 things. You can either 1, print money, 2, raise your own interest rates and try to boost your tax revenue, or 3, see a general decline in asset prices. And I think what we're seeing is a decline in asset prices. So that's where we are on that article. The next article is about South Africa. So South Africa, as you probably saw earlier in the segment, is on our emerging markets concerns list. But this article takes a different stance. Emerging markets, South Africa. So the fear in South Africa is the following, right? The fear is that a decline in asset prices, an increase in interest rates, and so on and so forth is going to start toppling the economy. There's talks about land redistribution, and investors generally don't like when assets get moved around without the market's involvement, right? And so this article actually gives us 4 good points for looking at South Africa in a positive way, right? The first is they have low dollar-denominated debt. And what that means is that they don't run into that same issue that China does because they don't borrow a lot of dollars, right? And that's really good because when our interest rates rise, their inflation tends to grow, and they currently have growing inflation, right? So they have increasing inflation. But increasing inflation actually keeps up with the dollar value, and they are predominantly an exporting economy, which means that the majority of what they make as a country in GDP is based on exporting things like natural resources and finished products and so on and so forth, right? So if they're an exporting economy, inflation in their country is actually positive for exports. And here's the reason, right? So if you used to be able to export $20 worth of goods, right? Now, at that same price, you're able to export 2 times as many goods at $20, right? Obviously, it's not as drastic, but you're able to sell more goods that are coming out of South Africa, which is predominantly, I believe, natural resources. But we will look at company profiles, and that's one of the reasons I want to run that series in the evening, is so that we understand when we're thinking about South Africa, where does their money come from? How are they making their GDP? What is the leadership like? What is the local history? How do local markets operate? How developed are they? Where does most of their money come from? And so on and so forth. Now, the next piece is they have a good stash of foreign reserves. Now, these are predominantly used to settle things like trade and cash flow balances and stuff like that, but foreign reserves are actually very positive. The reason is when you're borrowing money from a foreign country and something is going on with their interest rate, the issue is that your currency value changes. And when your currency value changes, you're not as able to leverage the reserves, right? And so having reserves allows you to pay back U.S.-dominated debt in U.S. dollars, yuan-dominated debt in yuan, right? And so having a foreign currency reserve gives you a little bit more strength and staying power. The third thing is strong leadership. Now, I won't comment on the current leadership in South Africa because, quite frankly, I'm not educated in this piece. However, what I will say is very important in terms of the way you perceive markets and the way you perceive leadership. Strong leadership, and what that means usually is that someone is centrist, someone is willing to represent both public and business interests, right? You don't want to represent only business interests and get public riots. You don't want to represent only public interests and have wild amounts of inflation and so on and so forth, right? So you're somewhere in the middle on those two issues. If you're somewhere in the middle on those two issues, you're able to enact them. You have a strong government in place in terms of institutions and everything else, right? You are able to enact change much faster. You are able to deal with crises much faster. And you are able to deal with and manage declining situations. Now, the former leadership of South Africa was considered very destructive. We'll go into a little bit of history about South Africa, and I won't cover it now because I truly just don't want to make mistakes when I'm covering it. But it was considered weaker. However, their Federal Reserve, which controls their currency, was still considered strong under the previous leadership. And what that means for an investor is that their Federal Reserve is independent, which is not the case in Turkey, right? This is the case in South Africa, and that's very good for weathering a financial crisis. Now, what's important here is the perception of leadership. So when you and I make predictions, we could make predictions based on what we think in reality will happen. But that's not a very good prediction to make, and the truth is that doesn't make you the most money, right? If you're investing in stocks, if you're managing a portfolio, what you are investing in most of the time is the perception that you believe other investors will carry. And if strong leadership is the perception, that's what you are investing on. Because right up until that strong leadership is proven wrong, everything in South Africa will be stable in rally. Right? If it is proven wrong, then it's bad. Now, you can have further insight and decide when they're making a mistake and so on and so forth. And we'll talk about investing based on geopolitical events. But the perception of leadership is very, very important for foreign markets. Okay, I actually picked up my coffee instead of my notebook. But the final point is that South Africa may stem the tide. And what that simply means is that the only reason we are seeing this emerging markets crisis is that we're seeing several emerging markets start to topple. And the fear is that more and more will topple. But A lot of that is based on perception. So if investors believe the markets are going to topple, they're going to exit and pull money out. As they pull more and more money out of these emerging markets will be more and more strapped for cash, and their economies will in fact tumble, right? As they see it happen in other places, more and more investors pull out, and so you get this idea of contagion. If, however, South Africa becomes a centerpiece, and it's already quickly becoming. So if you looked at the news last week South Africa was mentioned amongst the countries that might be a problem. This week, South Africa was mentioned amongst the problems, right? So South Africa is considered already to be an issue. However, if all of these things prove true, and they prove to be enough to weather the storm, this could be a way to stem the tide for what could be an emerging markets crisis. And so there is some kind of positive aspect here. So, having said that, that's today's news review.